Let me be very clear. I like Nvidia as a company, but I have not bought it yet. Why? Because I don't chase hype. I wait for the right price. And in this video, I'm going to show you exactly what that price is and why, if it gets there, I would probably buy it. If you've ever wanted to understand how real investors think, this is your video. Now, let's be honest. It's fun trying to find the next hot stock. It's fun to watch a stock skyrocket. Everyone wants to say, I bought it at before it 10x'd. And trust me, that thrill is awesome. But here's the thing that most people don't know or understand. Just because a stock's movement is exciting does not mean it's worth buying. Price is what you pay, value is what you get. And if you pay the wrong price, or the price is above value, even for the right company, even for the perfect company, you can still lose a lot of money. But the question we ask around here for every stock is always the same. What's it worth? The price on the stock market is not what it's worth. It's what it's selling for. Just like if you go buy a home, you say this thing is overpriced. The price is there. The value is something different. You're not going to hear this kind of breakdown anywhere else on YouTube. And that's why, if you're new to the channel, you need to stick around. Because most people are focused on stock price and stock movement. We're focused on the difference between price and value. So if you're tired of empty predictions and you want to actually understand when Nvidia becomes a great buy, not just a popular one, you're in the right place. So the question now isn't, is Nvidia exciting? It's, at what price is Nvidia a great investment? And that is what we're going to figure out. And in a few minutes, I will show you the price based on my assumptions that I think is fair value for Nvidia. But in order to make good assumptions with the stock analyzer tool, we need to look at the future potential, because when you buy an investment, you are paying today for all the returns you can get in the future, all the cash the business will generate in the future. You're not paying for the past, you're paying for the future. Now, I've read bull cases on Nvidia. I've read the bear cases, and I've got to tell you, there's a lot of excitement here. And the bull cases are the story. The bear cases are the risk. So let's start with the bull case. Nvidia's chips are absolutely the backbone of artificial intelligence. That's an absolute fact right now. If AI is the gold rush, Nvidia is the one that's selling the picks and shovels. If you don't understand the reference, there was a joke that back in the gold rush of the 1800s, the ones who made a ton of money were the ones selling you the picks and shovels, not the ones finding the gold. Everyone wants Nvidia chips. Their graphics processing units, which are the GPUs, are in massive demand across cloud computing, across data centers, and AI training. And guys, it's not just the chips, it's the entire ecosystem. Nvidia built CUDA, a powerful software platform that developers rely on to build AI applications. This makes it incredibly hard for competitors to catch up, even if they can match the hardware. Add to that the fact that AI market is expected to keep growing like crazy. Guys, if you think AI is hype, you're wrong. AI is the real deal. It is going to become more and more popular. Now, is it going to be as insane as people think? I don't know. I don't think everybody's going to be suddenly jobless because we're going to have robots everywhere. Maybe we do, but I doubt that. But AI is going to help with more data, more processing, more cloud. And guess who sits in the middle of all of that? Nvidia. Plus, they've proven they can adjust to challenges like government chip restrictions by tweaking products for different markets. That shows me that leadership has foresight. So yes, that bull case is absolutely compelling. Nvidia is dominant today. The market's still growing. If that continues, the upside for the business could be massive. But notice what I didn't mention anything there. Nothing about numbers, nothing about values, nothing about what price is appropriate for that. Now, guys, I want to show you a very extreme case, in my opinion, an extreme bull case on Nvidia that makes the stock look very cheap right now. And this one comes straight from a recent article on thestreet.com where one top analyst just dropped a price target of $350 per share for Nvidia. The analyst behind this bold call is Ananda Barua. Now, here's what the article says. He's one of the top-rated analysts in the industry, and he holds a 56% success rate, along with an average return of 14.1% across his stock calls. Now, I don't know what time frame that is, but it's something very interesting. Ananda's recent Nvidia call stands out in particular, where he reiterated a buy rating with a $350 price target. And they claim that his 13 prior ratings on the stock had an impressive 100% success rate. Now, this analyst sees Nvidia not just as a chip company, but as the foundational tech layer of the entire AI revolution, obviously. Ananda believes we're still in early, massive, long-term AI cycle, and Nvidia isn't just selling hardware. They're building the whole ecosystem. Chips, software, data center for infrastructure, all of it. Soup to nuts. This positions Nvidia to keep riding the AI wave as it expands across industries. But guys, his price target would take this company to be worth over $8.5 trillion. That's how extreme this bull case is. Now you might sit there and say, well, that makes sense. But again, let's talk about this. We're looking at my most extreme cases. 25% revenue growth for the next 10 years, 50% margin, 50% cash flow, 28 times earnings along the way, and only a 9% return. And that's where it's worth $435 per share. Maybe it can happen, but let's see what else this guy has to say. This is what he says. I want you guys to look at this. Barua argues that NVIDIA's next chapter in its never-ending growth story. Can anybody tell me a world in which a growth story doesn't end? Yes, companies still keep growing, but this massive, to say growth story means it has massive, massive growth. Guys, no company in history can possibly grow at these rates forever. And it's literally calling it a never-ending growth story. Now, obviously, there are three key drivers here. A fresh hardware cycle with new systems, dual revenue engines. Unit shipments are likely to surge, and average selling price will surge. So not only are they getting more units, the average price is going to be higher. It's going to be like a double layer of growth. And AI adoption acceleration, obviously banking on AI adoption. I don't disagree with these, but I shouldn't say that. I disagree potentially that the risk on the selling prices and the unit shipments. Guys, there are a lot of companies coming out now, reliable, great companies that are building chips that compete with Nvidia. When it's such a high gross margin unit, they're going to compete. Now, he does go on to say that the next leg is not just about shipping chips, it's about collapsing deployment time. You know, whenever a new product comes out, they're sitting there, they're trying to get more units out, it's hard, there's demand, etc. Well, guess what? If they collapse deployment time, if I'm a buyer of their product and I have to wait a year, I'm going to put as many orders as I can. But if I know I just have to wait a week, all right, I'll just wait. I'm not going to put the order in. I'll wait till I'm ready for it. I'm not saying this means NVIDIA is bad, but what it takes for NVIDIA to become an $8.5 trillion company, guys, an $8.5 trillion company, let's go over here. Let's call it this, 8,500, because $8.5 trillion. Divide that by 20 times. It should make $425 billion per year. $425 billion per year, which probably means it needs to do $1 trillion in revenue. Guys, it's going to happen, but when? I don't know if it's going to be anytime soon. It would take a lot for it to be soon. That's the concern here. There's no reference in any of this about valuation. He's just sitting there saying, oh yeah, he caught a bull market, and he kept saying, no, the price is higher. Guys, one of the biggest morons I know who works at Morgan Stanley now, I once asked him about the market, and he gave me some BS answer. And I'm like, oh my God. But he felt smart because the market went up 10%. But his reasoning for it was absolutely wrong. In fact, everything he said, he got wrong. But the result was correct. In his mind, he was correct. It's the same thing. A rising tide raises all ships. We don't know who's naked until the tide recedes. Now we enter the bear case. And it's important, especially if you're a long-term investor. NVIDIA is not alone anymore. AMD, even Intel, Samsung, other players are all building competing AI chips. Even more importantly, the big dogs, Amazon, Google, Microsoft, they're building custom chips in-house. That is vertical integration, and it means they may not need NVIDIA forever. And here's the danger in that. If your biggest customers become your competitors, your margins can shrink very fast. NVIDIA talks about it on their earnings releases. They say that 23% of their business comes from like one person, one company. Half the business, 60% of the business comes from like 7 people. Another risk, oversupply. Right now, everyone's racing to buy chips. Same thing that happened a few years ago with cars. But if that demand slows or too much inventory builds up, what happens to prices to get rid of that inventory? It kills profitability. We've seen this happen many times before in other industries. And also remember, NVIDIA's stock price today already assumes perfection. It's priced like everything is going to go right. But what if it doesn't? What if growth slows? The stock doesn't just flatten, guys. It could plummet and plummet hard. And here's the truth. When you pay a high price, even for a great business, you leave yourself little to no margin of safety. Now, let's shift gears and talk about an extreme bear case for Nvidia that might not be as extreme in probability as the extreme bull case we looked at. And this one comes from Andrew Zotlin over at Moneyball Economics. Zotlin isn't just throwing cold water on hype. He's bringing in historical perspective. In the article and video, he compares Nvidia's current rise to Cisco Systems back in the early 2000s. Guys, have you heard that anywhere before? Same story. Dominant company, massive demand. Everyone wanted in, and the stock price skyrocketed. But once growth slowed, even slightly, the stock collapsed. And it pulled a chunk of the market down with it. This was the company that was supposed to be the first trillion-dollar company. You had to have it in your portfolio, or you were stupid. Guys, they hit a high in 2000 that they have not hit since, 25 years later. Yet their profit and revenue are up 3 or 4 times since then. Today, Nvidia is up nearly 8 times in under 2 years. Its tech powers the AI world, and that dominance has made it the most important stock on Wall Street right now. But there's a concern. Zotlin says it's priced for perfection. Have you heard that before? And when the growth starts to slow, which it will, it always does, the downside could be brutal. He points to early signs like Taiwan Semiconductor sales. Taiwan Semiconductor is Nvidia's chip supplier. They just saw a steep drop in their sales. That could be the first crack. And if big buyers like Google, Microsoft, or Meta start saying, you know what, we've built out enough AI infrastructure for now, that's when things start to unravel. If there's less demand for AI, guys, a year ago, everyone went to AI for everything. I'm hearing more and more people now say, you got to be careful with AI because it's not exactly accurate. They're going to work through those kinks. It's going to get better. That's an absolute fact. But don't think that everybody's jumping on this train to be 100% right. Guys, I use it all the time. We use it on this channel all the time. It is great, but we still try to double check our facts. Zotlin thinks this won't be a slow fade. He thinks it'll be a sudden drop, a pull the rug out kind of moment, sometime in the next 6 to 9 months. I have no idea. I don't know if that's correct. Who knows what's going to happen? Frankly, no one does. He even suggests it could be a Cisco-style collapse where over-leveraged investors get caught, panic selling kicks in, and the whole AI ecosystem will feel the pain. And guess what will happen? When that ecosystem feels the pain, the rest of the market will as well. Guys, I'm not here to talk about Nvidia being doomed. I do not think it's doomed. But if you're a principle-driven investor like we teach here, this is exactly why you don't want to chase hype. As much as it'll suck to see a stock go up that you didn't buy. But you don't buy something just because it goes up. You look at the fundamentals. You ask, what am I getting for the price I'm paying? I would rather, you told me today, Paul, would you rather 10x over 1 year or 10x over 10 years on multiples? I'd rather 10x over 10 years, of course. That's my opinion. But if Nvidia slows just a little bit, and it's already priced for the nonstop growth, the fall could be a lot steeper than most people are ready for. Nobody is pricing this in or factoring in a chance that Nvidia just falls very hard, very fast. In fact, I just see the markets keep going up and up and up. Look at this. He writes, I was at Cisco Systems in the 90s and the 2000s, and let me tell you something. What I'm seeing with Nvidia is one-to-one with Cisco. Cisco was the leader, the dominant force in the router switch technology field, and that enables the internet. Basically, all internet traffic is using Cisco gear back then. As a result, everyone needed Cisco gear, and demand outstripped supply. Guys, look at electric cars. They couldn't make Teslas fast enough. Now they can't give them away. You couldn't make a Cybertruck fast enough. Now you've passed any Tesla dealership, they're loaded with Cybertrucks. This is the way we go in cycles, guys. Death, tax cycles, always the way it is. So what's my take? Guys, I like a story. I don't fall in love with a story. I don't fall in love with the stock price going up and down. I fall in love with the fundamentals. I fall in love with the numbers behind the stock price. Nvidia, without a doubt, is a great company. But that doesn't make it a great investment at today's price. And that's what we're doing here. We're trying to separate the story from reality. Understanding how the business makes money is essential. Looking at the risks and asking the only question that matters. Is the price selling below intrinsic value? Because we aren't speculators, we are investors. And when you stick to principles, you don't have to predict what happens next to Nvidia. You just have to understand the business and stay patient until the math makes sense, and then let Nvidia's good management take over. Once you've bought in at a good price, let them do their thing. That is how real wealth is built in the long run. Now, guys, there are no guarantees in life. Everything we do here on this channel is about teaching a process. The process I teach is to be applied to lots of different businesses. I don't know if I'm going to be right or wrong in any individual company. But what I do think, and I do believe, and I do know is that if I apply this sound principle to a package of companies, I will do well. That's what I'm trying to teach here. It's not saying buy, it's not saying sell, it's saying this is how I want you to think. This is how I think. Take from it what you want. You know why? Because most investors are going to lose money because they're trying to pick the next big winner. The best investors do the exact opposite. They eliminate the losers first. And unfortunately, sometimes the biggest losers are the ones at the highest valuation. But everyone ignores that. I want you to be different. If I ask a room of 100 people, who here is the same as everybody else? Nobody's going to raise their hand. If I say, who here is different? Everybody raises their hand. But these are the same people that are going to buy Nvidia at any price. You're going to be different. That's the big thing here. So let me explain, especially to new viewers here, a little bit about the numbers behind Nvidia. So the company current market cap is $4.9 trillion. If you buy every share outstanding right now, you'd spend $4.9 trillion to own it. Here's what's incredible. Their enterprise value is 4.89. It's lower. This means they essentially have no debt. The difference between these two numbers, if it's a positive difference, enterprise value is higher than this, that's the debt level. Their enterprise value is lower than their market cap. Incredible. Now, net income, 86 billion, 5-year average, 33 billion. So for the 5-year average is 33 billion, the 1-year number is 86. This is what profit did. If they're closer together, profit's growing like this. That's what I want you to see here. There's a lot of growth here, which is exciting. But remember, easy come, maybe easy go. I don't know exactly. This company is selling for 30 times sales. Guys, that's a lot. That means for every dollar of revenue, you have to pay $30 for it. Not every dollar of profit, every dollar of revenue. That's the money coming in. When they sell a chip for $1,000, that's $1,000 in revenue. They might make $400 on it, but the $1,000 revenue is the big number there. Guys, great returns on capital. What this means is this company does a great job of getting a good return on the money they invest in the business. So, we talked about profit. We talked about returns on capital. We talked about growth. Which one of that was bad? None of it. The only bad thing I said was the price to sales ratio. Guess what? PE, 57. Price to free cash flow, 68. This is incredible, guys. This is absolutely incredible. Great business, and I think a lot of people have taken it a little more extreme. Look at these growth numbers in revenue. 77% a year for the last 3 years. 66% a year for the last 5 years. 42% a year for the last 10 years. I'm going to go back 10 years ago, slap myself and say, Paul, put your entire net worth in Nvidia. Of course, I'm being somewhat jokey. But guys, this is exactly why I teach on YouTube. I teach this because I want people to realize there's another way of thinking. It's not just chasing a stock price. And yes, I went through a lot of key metrics here. These metrics are important no matter what company you're looking at. So it's really important. I want you to sit there and have this at your fingertips. So I created a very simple and easy cheat sheet. All of these metrics in a very easy PDF and explains all those metrics to you. If you click the link below, sign up for the email. It'll be sent to you very quickly. You'll be able to look at these metrics handy. That way, next time you watch one of our videos, you're ready to go. And more importantly, when you talk to your friends, you can now be the smartest person in the room when you tell them, yeah, but what's their price to sales ratio? Because if you know, it's really important to blah, 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 blah. You're going to be brilliant. So go sign up for that PDF right away. So guys, let's go to the 8 pillars. And this is something that our channel is very known for. This tells a story. We have 6 checks, 2 X's. Net income growth, revenue growth, cash flow growth, all check marks. Very low debt, beautiful. Bought back some shares. I'm not going to worry about when they were bought back, but great. Returns on capital, awesome. The 2 X's are valuation. 5-year PE, 5-year price to free cash flow. This takes the last 5-year average of earnings and divides the price into it. Guys, these are very high. Now, I want you to keep in mind, just because they're X's doesn't mean it's bad. Guys, if God came down here right now and said, Paul, Nvidia is going to grow its profit by 200% a year for the rest of time. These are cheap. This is nothing. I would do that in 2 seconds. Great, sign me up. I'm there. But it's about understanding what the future of Nvidia holds. And at some price, it becomes too expensive. So let's go see what analysts think about the growth of Nvidia. These are the people chasing Nvidia. Earnings per share, $3 per share, growing to $9.10 according to them in the next 5 years. $9.10. Okay, that's a lot. That's triple. Revenue growing from $132 billion to $391 billion also in the next 5 years. Look at these growth rates. That's huge, guys. Huge. This company has a lot of potential if they come through. Remember, these are also the analysts. And I like looking at analyst estimates as a guideline of what people are thinking because these guys talk to these companies very regularly. But it's important to remember that you have to understand there's a price that's too high to pay. And you have to also remember analysts can be wrong regularly. They are wrong regularly. They still have career risk. So they want to be like the rest of the market. It's going to be hard pressed to find an analyst who says a company's overpriced. If you're scared of losing money in the market, I know why. You've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. Now, guys, we have the story here. We have an idea of the numbers. And what I always tell people is when you're going to do a company, when you're going to look at a company, look at the numbers quickly, look at the key metrics, look at the 8 pillars, but then go right to Stock Analyzer tool. I want you to make sure you're not wasting your time. Nvidia is selling for $200 a share. If you run the numbers and your numbers make the Nvidia value $60, why would you spend any more time? It's too far away. Just add it to your watch list here and you'll get notified at whatever price you want to notify yourself at. Don't waste your time on companies that are massively overvalued. Spend your time on companies that are worth your time. So I'm going to pull up the last time I did Nvidia. And guys, last time I did it, I made very aggressive assumptions. The hardest part about companies and putting in good assumptions is we don't know the future. The future is unknown. So how do we get these assumptions right? This is what's really important to understand. Now, I'm going to sit here and I'm going to look at these. I'm going to explain these numbers to you. I'm doing a low, middle, and high assumption. Very first line is actually return on invested capital. Look how much it's grown. Incredible. Next line, revenue growth. Guys, I did 10, 15, and 25% revenue growth. Okay, some people are going to disagree with me on this one, but I did go much higher on the high side here. Profit margin, 35, 40, and 50%. Could be low. So here's what I'm going to do for the people out there. I'm going to do 10, 20, and 30%. And for profit margin, I'm still going to stick with 35, but I'm going to do 42.5 and 50. Now, PE and price of free cash flow. What is the PE or price of free cash flow you expect it to sell for 10 years from now? Well, guys, what I always tell people is start with 15 or 16, which is the market average, but go higher for great companies, lower for bad ones. Can we all agree Nvidia is a great company? Great balance sheet, great return on capital, great product, great growth. Everything is awesome about it. Great margins. If anybody says it's not a great company, then there's some fraud out there that's happening and they end up being right because I have no idea. I don't see it. It's a great company. So what's the right PE 10 years from now? Remember, it's a more mature company. The big growth is probably past its way. So I put 18, 22, and I went a little bit higher than the 26. I went 28. And finally, what is my desired return? Guys, I always put in 9 or 10% here because I want the intrinsic value. What's the value of the business? Not what return I want to make right now. But for you, when you're buying a company, you need a margin of safety. You need a higher desired return because if you just want 9%, go buy a low-cost ETF. Save yourself the aggravation. So I'm gonna hit the analyze button. It's gonna give me these numbers. The stock is currently at 202. Well, guys, I have a low price of 70, high price of 630, middle price of 208. So what does this mean, guys? What this means is, if you believe these numbers above, take a look at it. Now, before you go, I want to show you my real assumptions, what I would underwrite at. I'm doing this. I actually like those. Actually, apart from the growth rate, I'm good. All right, I'm at 670, 435, and 140 in the middle. So for me, I'm just being patient. I just got to wait for the right price. I'm going to add it to my watch list, probably at $120 a share. And when it gets below then, I will reevaluate. Now, before you go, earlier this year, I picked 7 stocks to start the year to go head-to-head with the market's Magnificent 7. I made my own Magnificent 7. So click the video on the screen to see which stocks I picked and how they stacked up, because the results year to date have actually surprised me, and I'm sure they're going to surprise you as well. Thank you for your time.